Hey everyone, and welcome to The Explainer. Today, we're diving into a topic that's probably been dominating your newsfeed, the historic pressure on the Indian Rupee. We're going to look right past those daily headlines to investigate the deep, structural forces that are dragging our domestic currency down. And more importantly, we'll break down exactly what this means for the broader economy and, well, your everyday purchasing power.
Okay, let's dive right into this. We constantly hear about the rupee weakening against a super strong US dollar, right? But take a look at this anomaly. Since May 2025, the Indian rupee has actually dropped a massive 11.86% against the Pakistani rupee. That is a truly critical piece of data. It forces us to look beyond just the global dollar strength narrative and figure out what is really shifting beneath our own feet. And that leads us straight to the high-stakes question on absolutely everyone's mind right now. With the currency recently breaking past that 96 per dollar mark and hitting fresh record lows, is a three-digit exchange rate, 100 rupee to $1 reality, inevitable? Market experts are actively debating this right now, and to find the answer, we really need to forensically examine what exactly is pulling the currency down.
So let's kick things off with Section 1, the investigation. It's time to unpack the rupee's fall.
To really understand this drop, we have to separate the external, global scapegoats from our own internal, domestic realities. Just look at these exchange rates. Back in May 2025, right around the time of the 88-hour Operation Sindoor and the ceasefire, one Indian rupee bought you roughly 3.29 Pakistani rupees. Fast forward a year to May 2026, and it's fallen to 290. The wild anomaly here is that Pakistan recently entered a really strict IMF program with severe fiscal measures, yet the Indian currency is the one losing ground against it. What does that tell us? It suggests India's economic challenges are fundamental and domestic, not just something we're importing from the rest of the world.
Now, looking back, the historical contrast here is pretty stark. Back in 2012 and 2013, the current ruling party heavily critiqued the previous government for the rupee's decline, basically framing a falling currency as a failure of governance. Yet today, that exact same government is navigating a severe depreciation of its own. It's a neutral yet fascinating reminder that raw macroeconomic realities often outmatch political rhetoric, no matter who happens to be sitting in the prime minister's chair.
And this brilliantly illustrates what those macroeconomic realities actually are. The rupee is currently trapped between two massive opposing forces. On one side, you have global shocks. Escalating tensions in West Asia are pushing Brent crude oil well over $100 a barrel. On the flip side, we have domestic strains. Foreign portfolio investors have yanked out roughly $21 billion in a really short window, and that's happening alongside a rapidly widening trade deficit. It's literally a perfect storm.
But, there's a hidden layer to this storm. It's kind of like a dam breaking. Between 2023 and 2024, the Reserve Bank of India, the RBI, burnt through foreign exchange reserves to artificially stabilize the rupee, keeping it in this really tight band of 81 to 83 per dollar. They essentially held back natural market forces. But as we all know, you can only hold back water for so long. Now that the pressure has completely overwhelmed the dam, this current fall feels incredibly steep simply because the market is suddenly pricing in 2 whole years' worth of delayed depreciation.
Let's quickly walk through the balance of payments data because this shows the real structural shift. In 2023-24, India was sitting pretty with a massive surplus of $64 billion. That surplus made it relatively easy for the RBI to defend the rupee. But look what happened in 2024-25. That massive surplus just vanished, swinging all the way back to a deficit of $5 billion. Simply put, when more money leaves the country for imports and investments than what's coming in, the domestic currency is fundamentally going to weaken.
All right, let's move on to Section 2, Impact on Your Wallet. Let's find out who actually wins and who loses here.
Because let's be real, in a currency slide, the pain isn't shared equally. The losers are pretty obvious. Industries that rely heavily on imported raw materials. Think aviation dealing with insanely expensive jet fuel, or just everyday consumers trying to buy imported tech. But get this, there are winners too. Export-driven sectors like IT services, textiles, and pharmaceuticals actually profit. Why? Because their overseas dollar earnings convert into a lot more rupees when they bring that money back home.
But for the average consumer, the biggest headache is without a doubt the domino effect of expensive crude oil. Remember, India imports nearly 90% of its oil. To put that into perspective, a recent State Bank of India report highlighted a startling fact. Even a minor depreciation of just 2 rupees against the dollar completely wipes out the benefits of any recent domestic fuel price cuts. And that inflated fuel cost? It immediately cascades. It hits transportation, aviation, and eventually even the cost of the packaging on your everyday household groceries.
So, what can be done? Let's jump into Section 3, the RBI's Rescue Playbook.
Now, what's really interesting about this slide is seeing the actual arsenal the RBI has left in its war room, especially with inflation fears rising. First, they can start with aggressive direct dollar sales straight from their reserves to smooth out market volatility. Next, they can use dollar-rupee swap operations to manage banking liquidity. If things get really bad, they can hike policy interest rates to try and attract foreign capital, though, full disclosure, that risks hurting our own domestic growth. And finally, there is the nuclear option.
Yep, that break glass in case of emergency option is the revival of FCNR deposit schemes. This is a direct, fascinating parallel to the 2013 taper tantrum crisis. Basically, under this mechanism, the RBI and domestic banks go out and actively mobilize foreign currency deposits from non-resident Indians by offering them really attractive rates and swap windows. It's a drastic survival mechanism designed to quickly pull billions of dollars into the country to stop a free fall dead in its tracks.
Which brings us to our final segment, Section 4, the ultimate question, the race to 100.
So what actually has to happen for us to breach that massive psychological barrier of 100 rupees to the dollar? Well, according to market experts, it would take a very specific worst-case sequence. Step 1, geopolitical tensions in West Asia worsen significantly, driving Brent crude oil up to a staggering $150 a barrel. Step 2, that massive exodus of foreign portfolio investment we talked about continues at the exact same relentless pace we saw in March and April. If those two forces combine and totally overwhelm the RBI's defenses, Step 3 becomes a reality. The rupee drops to 100.
As we wrap up this explainer, I want to leave you with a really provocative question from an economist who is reviewing this exact situation. They asked, can Band-Aids heal a deeper structural wound? Think about it. Interventions, selling off dollars, and rolling out emergency deposits can absolutely stabilize the daily ticker price. But until the much deeper structural issues of trade deficits and our reliance on foreign capital are addressed, that downward pressure, it's going to remain. Thank you so much for joining me to unpack all this data today, and definitely keep your eyes on those vital indicators. See you next time.